1A. That's all Tyler's financial advisor charged him. Just one tiny percent. It sounded harmless. Almost nothing. That 180 ended up costing Tyler over $340,000 across the lifetime of his portfolio. And he thanked him for it. The truth is, almost everything you think you know about investing is wrong. And I'm not talking about tiny technical mistakes. I'm talking about expensive myths. Myths quietly draining your wealth while you think you're being smart. In this video, I'm breaking down 13 investing myths you probably still believe, with real calculations showing how much each one can cost you. And the last one? It's the most expensive lie in all of personal finance. Let's begin. Myth number 1. A 1/8 advisor fee is basically nothing. This is the myth that creates all the others because it sounds completely reasonable. 1%, just a penny on every dollar. Your advisor probably told you it's standard. And you believed it. Why wouldn't you? But let's do the math Tyler never did. Suppose Tyler has a $200,000 portfolio growing at 80% annually for 30 years. Without the 1A fee, his portfolio would grow to around $2 million. With that fee reducing returns to 7%, he ends up with around $1.5 million. That tiny 1A didn't cost him 1E. It cost him nearly $500,000. And here's the worst part. You don't pay that 1A once. You pay it every year on an increasingly larger balance. The fee compounds against you with the same power that returns compound for you. It's silent, invisible. You never see it clearly on a statement. But you feel it decades later when your retirement account is missing hundreds of thousands of dollars. Tyler thought he was paying for expertise. He was paying for a handshake and a quarterly email. But at least his advisor is picking the right stocks for him, right? Myth number 2. Stock picking is how you get rich. This is the myth behind every investing app, every stock newsletter, every YouTube thumbnail with a giant green arrow. The belief that if you're smart enough, research hard enough, and find the right stocks, you'll beat the market. Except over a 15-year period, roughly 95% of actively managed funds, run by professionals with research teams, analysts, and billion-dollar resources, underperformed the S&P 500, 90%. These people do this professionally and still lose to a simple index fund that basically does nothing. And the fees make it even worse. You pay more money to get worse results. It's like hiring a personal chef who burns your dinner and charges double for it. If professionals with every possible advantage can't consistently beat the market, what makes Tyler think his late-night Reddit research will? Okay, but surely higher risk means higher reward, right? Myth number 3. More risk always means more reward. People repeat this one constantly, without ever questioning it. Go big or go home. Tell that to investors who lost everything in penny stocks, or leveraged ETFs that slowly decayed over time, or meme coin holders currently sitting on 95 TT losses. Yes, risk and reward are related, up to a point. Beyond that point, you're not investing anymore, you're gambling. And the house has better odds. The greatest long-term returns in market history came from the most boring investments imaginable. Not risky bets, not moonshots, index funds. And Tyler completely ignored them. But maybe Tyler can still win by timing the market perfectly. Myth number 4. Timing the market beats time in the market. Buy low, sell high, wait for the dip. Sounds simple enough. Here's what actually happens. If you invested $10,000 into the S&P 500 for 20 years, but missed just the 10 best trading days, only 10 days out of roughly 5,000, your total return would be cut almost in half. Miss the best 20 days, and you barely beat inflation. And here's the brutal part. Most of the best days happen immediately after the worst ones. The market crashes 30%, then suddenly explodes upward days later. If you panic and sell during the crash, you almost guarantee missing the recovery. Nobody does this consistently. Not hedge funds, not algorithms, not the guy on CNBC yelling over sound effects. The data is overwhelming. Consistently investing over time through dollar cost averaging massively outperforms, trying to predict perfect entry points. Here's a real example. In 2000, Tyler and Sarah each invest $10,000 right before the dot-com bubble bursts. Tyler panics, pulls his money out, waits for the right time, and keeps waiting. Sarah does nothing. She barely even checks her portfolio. By 2020, Sarah's investment grows to over $30,000, despite living through 2 of the worst financial crises in modern history. Tyler finally gets back in around 2013, after regaining confidence. His investment grows to around $17,000. Same starting amount, same market. Tyler's smart strategy cost him $13,000. Sarah's strategy? Literally nothing. Tyler spent years trying to outsmart the market. The market didn't even notice. And when the market crashes, Surely everyone knows what to do, right? Myth number 5. A market crash means you should sell. Everything is red. The news says things will get worse. Your instincts scream, get out before it collapses further. During the 2008 financial crisis, the SUP 500 fell roughly 57%. By 2010 it had fully recovered. During the COVID crash in 2020, the market dropped 34%. It recovered in about 5 months. Every major market crash in history was eventually followed by a recovery that surpassed the previous peak. Every single one. The people who suffered most weren't the ones who held. They were the ones who sold at the bottom and locked in losses forever. A crash is not a funeral, it's a clearance sale. And Tyler just returned his investments at a 60% discount. Now let's talk about another guaranteed investment. Myth number 6. Real estate always goes up. You can never lose with real estate. Everyone says it, parents say it, co-workers say it, the internet says it. But adjusted for inflation, the average home appreciates only around 1% annually. Meanwhile, the SUP 500 historically returns around 70% after inflation. But nobody's selling houses once you're comparing those numbers. And appreciation is only half the story. Let's look at what Tyler actually pays every year. Property taxes, insurance, maintenance, repairs, HOA fees, closing costs when selling. A general rule says maintenance alone costs about 1% of a home's value annually. So Tyler's house may appreciate 1%, while upkeep quietly consumes 2% to 4%. In many cases, his home isn't building wealth. It's draining it slowly while he proudly checks Zillow estimates. And people saying, real estate always goes up conveniently forgot 2008, when home prices crashed over 30% in some markets and took nearly a decade to recover. Now, I'm not anti-real estate. Rental properties, REITs, and strategic investing can absolutely work. But the idea that my primary house is my best investment is a myth that needs to die. A house is a fantastic place to live. It's often a mediocre investment. Tyler confused the two, but at least dividends are free money, right? Myth number 7. Dividend stocks are free income. Tyler loves dividends because they feel like passive income. Money magically appearing in his account. But here's the problem. On the ex-dividend date, the stock price usually drops by approximately the same amount as the dividend paid. If a stock pays a $2 dividend, the stock price typically falls around $2. You didn't gain extra money. Your investment just moved money from one pocket to another. And in taxable accounts you may owe taxes on it too. What actually matters is total return. Price growth plus dividends combined. Many high-dividend portfolios underperform growth portfolios over the long term because those companies distribute cash instead of reinvesting into expansion. Tyler celebrated a $500 dividend payment. His portfolio dropped by roughly $500 the same day, but the notification made him feel rich. Now maybe none of this matters because investing requires a lot of money anyway, right? Myth number 8. You need a lot of money to start investing. This myth keeps millions of people stuck on the sidelines. I'll invest when I make more money. Small amounts don't matter. Really? Investing just $100 a month for 30 years at a 10% annual return grows to around $226,000. $200 a month becomes roughly $452,000. 200x the fractional shares, you can invest in the SUP 500 with as little as $1. The barrier to entry disappeared years ago, but here's the part Tyler should lose sleep over. The real cost isn't the money you didn't invest, it's the time you lost. Compound interest needs time more than size. Every year you wait doesn't just cost you the amount you skipped investing, it costs decades of future growth. $100 a month is not insignificant, it's the price of giving up. And Tyler has been paying that price for years without realizing it, which leads to myth number 9. You're either too young or too old to start investing. Young people think they have forever, so they wait. Older people think it's too late, so they never begin. Both are wrong. The math destroys both excuses. Investing $300 a month from age 25 to 65 at 81 annually grows to around $1.5 million. Around $440,000. Waiting 10 years didn't cost Tyler $25,000. It cost him more than half his future wealth. That delay erased over $600,000. And older investors aren't too late either. Even starting at 45, investing $500 monthly until age 65 at 80 IEA grows to roughly 286 still matters. Even starting at breed is no age where the answer becomes, don't bother. There's only the increasing cost of waiting longer. The best time to start was yesterday. The second best time is before this video ends. So Tyler finally starts investing, and his first choice, an index fund. Boring. Which brings us to myth number 10. Index funds are mediocre. Why settle for average returns? Because average market returns have beaten roughly 90% of professional fund managers for over 15 years. Being an average investor in the stock market literally places you in the top 10 EPUA of investors. Think about that. Warren Buffett once bet $1 million that a basic SEP 500 index fund would outperform a carefully selected group of hedge funds over 10 years. He won. Easily. Being average is the secret. You just have to be boring enough to accept it. Tyler isn't boring enough. That's exactly why he's losing. But at least his portfolio is diversified. Right? Myth number 11. Diversification means owning lots of stocks. Tyler owns 30 different stocks. Apple, Google, Amazon, Microsoft, Tesla, Netflix, Nvidia. He thinks he's diversified. Then the dot-com bubble bursts, the Nasdaq crashes 78 here, and all 30 stocks collapse together. Because they were all tied to the same sector, driven by the same forces, exposed to the same risks. Tyler owned 30 stocks. But only one bet. Quantity. It's about different asset classes. Domestic stocks. International stocks, bonds, REITs. If everything in your portfolio crashes at the same time, you're not diversified. You're concentrated with extra steps. And speaking of fake safety, myth number 12. Gold is always a safe investment. When everything else fails, gold holds value. That's the sales pitch. But over the last 50 years, gold's inflation-adjusted return has been roughly 1A to 2A annually. 500, around 7 AE. Even worse, gold stayed almost flat from 1980 to 2005. Years of nearly zero real returns while the stock market exploded upward. Gold has a role, a small one, maybe 5 to 10 year save a portfolio as a hedge. But as a primary investment strategy, at best, it preserves wealth. At worst, it destroys opportunity. Gold doesn't create wealth, it just feels like it should. And finally, the biggest myth of them all. Myth number 13, pay off all debt before investing. This one sounds responsible, safe, logical. Tyler has $20,000 in student loans at 4% interest. He aggressively pays an extra $500 monthly and becomes debt-free in about 3 years. Feels amazing, looks smart. But let's compare two paths. Path 1. Tyler pays down debt first, then starts investing afterward. After 30 years, he ends up with roughly $680,000 invested. Not bad. Path 2. Tyler invests that same $500 monthly immediately while making minimum loan payments at 4%. The loan lasts longer, but after those same 30 years, his investments grow to roughly $850,000. That's a difference of $170,000. Same income, same monthly amount. Only one thing changed, where the money went first, because every dollar Tyler sent toward low-interest debt was a dollar denied decades of compound growth. His earliest dollars were the most valuable ones he had. And he used them eliminating cheap debt. This is the difference between emotional math and real math. Emotionally, all debt feels dangerous. Mathematically, low-interest debt can actually be one of the most powerful financial tools available. Now, important warning. High-interest debt, especially credit cards charging 20 BP or more, should absolutely be eliminated quickly. That logic reverses completely. But treating all debt as equally bad is one of the most expensive oversimplifications in personal finance. And honestly, the most expensive investing myth isn't just one of these. It's believing all of them at once. Every myth Tyler believed carried a financial cost, and together they compounded against him. 13 myths, thousands, maybe millions, lost because nobody questioned them. But now you know. And knowledge compounds too. And if you think the investing world is full of lies, wait until you see what car dealerships are doing to people. Because the biggest myth about investing is that it has to be complicated. If this changed the way you think about money, like this video and subscribe to Wealth Logic for more.